All right, guys, I want to make a quick video further explaining the assumptions behind this tweet. I tweeted this tweet out, I guess it was July 12th. I'll link it down below in the description of this video. And basically, is responding to, there's often a commentary. People look at Lemonade, they look at it briefly, and they kind of summarize, well, Lemonade, they're just not very profitable. They're just losing a lot of money. That's kind of the end. That's where it goes. That's the whole analysis. It's very sort of simple surface level analysis. And they don't seem to understand, the investments Lemonade is making now and how it's going to play out. And I suggested in that tweet that, hey, if you look at, even it's a bit of a cherry picking situation, but if you look at Q1, if I make this picture bigger, if you look at Q1 where they're sort of, I'm calling it gross profit, is just how I'm modeling their profits after you factor in their insurance expenses. So that level of profit, I'm saying it's going to triple from Q1 up till the end of 2027, Q4 2027. It's going to maybe roughly 3x over the next 2.5 years, which is really incredible growth. And I explain here in the tweet some, how are they going to get there? Well, top line's going to grow 30% or more per year. Your IFP, your in-force premium, or your premiums are going to grow at that rate. Your reinsurance now is you're taking on more of their risk yourselves. It's going to drop from 55% to 20%. And then, that improves your gross profit, and then that's going to get you to your profitability. Then I also explain here in the tweet that the rest of their operating expenses are going to go from, maybe 131 million to 158 million over that span of time. So as you're 3xing your gross profit, but your operating expenses are increasing, but at a much slower rate, you're going to reach profitability by, sometime probably in 2027, net income profitable. Adjusted EBITDA profitable will come sooner in 2026, but net income profitable somewhere in 2027, I think, is what's going to happen based on based on how I'm modeling it, but also based on management's own guidance. So what are the assumptions behind this math? If we go a little bit deeper, so I open up my Lemonade model, which is available to all my Patreon members. The next tier of $5 tier for my Patreon will be eventually selling out, probably maybe sometime this year. We'll see. But this model is available there, and I continue to update it there. I have that graph shown here in that model, and as you can see, I'm just going to pull up the main assumptions here. Is that your in-force premium is going to grow from around is going to grow to 2.1 billion by 2027. So if you look at, I just pulled in-force premium right here, probably 2 point some billion by the end of 2027. So you have your reinsurance tapering down. Let's flip over to the model here. Your reinsurance tapering down from 55%, tapering over the next few months, and then at 20%. And then your annual dollar retention, I believe, as CAGR is going to roll out, we're probably going to see this in the 90s, maybe even could even go over above 100% annual dollar retention. If you're new to Lemonade, annual dollar retention is just a metric that Lemonade releases that looks at a cohort of customers, or the whole customer sort of book of customers at a given time, and then 12 months later, what the overall premium change of that customer base is over 12 months. So that would include customers churn away, that's factored into that. If customers cross-sell, upsell, buy a car or other products, that's factored into that. But as CAGR rolls out, even though customers are always, churning away or leave for whatever reason, that's natural and occurs, your annual dollar retention could potentially really go above 100. But I'm only modeling it here kind of 80s, 90%. If I highlight that here for you guys, 80, 90%. We're in the high 80s and then go into low 90s through the end of 2027. And annual dollar retention, I've touched on this before in other videos and places, but touched on it again, 84% was in Q1. People sometimes say, why is annual dollar retention slipping? That's just because 12 months prior, they started canceling around that time frame over the past year and a half, really non-renewing a lot of the sort of unprofitable home customers. So you're seeing that reflect 12 months later in your annual dollar retention, and that sort of 12-month reflection shifts a little bit. But I expect that's now going to start going higher, and with cars really rolling out 2026, 2027, honestly, probably going to be higher than I'm showing here, but for the sake of that, of how I've inputted here, I'm going to have it in low 90s. And again, if you want to get this model, it's only $5 a month, and then you can play with it yourself and adjust these to whatever you would think it should be or might be, and see sort of the range of outcomes. And then next one is gross loss ratio of 67%, net loss ratio of 68%. And you might think, wow, that's that's really significant. If you look back at previous few years ago, they're 90%, 80%, 90%, even over 100% net loss ratio in one quarter. But if we look at where they've been heading and trending down, if you look at gross loss ratio, last quarter was 78%, but before that, Q4 of 2024 was 63%. And that was because this last quarter was higher simply because there was those Los Angeles fires that pushed the number up some. But if you look at gross loss ratio X catastrophic events, so it was 59% last quarter. Who's to say that even by sort of average loss ratio, maybe it starts hitting in the low 60s, and then they have the odd catastrophic event that pushes that up higher, maybe into the 80s with less reinsurance, but otherwise in the other quarters, maybe they're at 60%. It would not be impossible, but I'm modeling 67% in my assumptions behind that tweet. And then another major metric in my model is this conversion of gross spend or customer acquisition cost. So it's a portion of your sales and marketing that really is the variable cost. There's a portion of sales and marketing that Lemonade lumps in. And I have it distinguished here. Sales and marketing is a figure they release, but then you'll see in some of their earnings letters, earnings calls, they'll mention, and they become better at this over time. They used to, a few years ago, they didn't really differentiate this as much, but they started differentiating a sales and marketing, a growth spend portion of that. And then a fixed, I'm calling a sort of fixed portion is more sort of your overhead related to sales and marketing. And that's been very steady, and it dropped actually by about $5 million last quarter. I think that was because that some Chewy shares issuing that was canceled, if I remember right. So anyways, but the growth, the variable portion or growth spend portion, if I pull this up here again, so I'm looking at, hey, for every dollar you spend in growth, how much IFP or top line premium are you getting? And I'm picking a variable 2.7. You can see this variable here is, it's varied quite a bit by quarter. It depends on the time of year, and it depends, what products and or what places. It depends how much you're spending on marketing. But it varies. It jumps around quite a bit. It was lower in 2023 because they're spending a lot less on growth spend. As they've ramped it up, it's decreased. You might say, wow, they had 2.4, 1.9. Is that, 2.7 for last quarter? Is 2.7 too high? Well, I don't think so. Sort of an overall average, especially over the next few years, because they have this large base of customers and really expect that car is going to be heavily pushed. It's going to keep ramping up in 2025 and then heavily push 2026 and onwards. And that pushing out of car, if you flip back to, if you just look at this table right here from the Q1 letter, it's been in the last few letters. Your IFP per product your premium per customer, per product. Car has over $1,850 per customer per product. So you start cross-selling into that customer, it's going to really, really help. You're getting, say, premium for free that you're already cross-selling, then it makes the premium that you are spending dollars for look much more effective. So honestly, I think 2.7 might be a conservative figure over the next couple years again. But that oops, messed up my whole model there. But that factors, and again, this 2.7, that factors in the premium you have to overcome from customers that churn away, plus the premium you have to get just to grow the book or grow the top line. So it factors in both those things. It's just premium that's coming in the door, if that makes sense. So 2.7 there, and then the other sort of main assumption behind this is that operating expenses minus gross spend will stay flat, roughly 93 million per quarter. So I have it total operating expenses right here. It's about 130, 138, 131 million last quarter. As they ramp up growth spend, it's going to keep increasing more and more, and I have that going to maybe 165 million right now. It depends. There's different variables to play with here, but if you look, most of that is being driven by you're growing the top line, and then you're spending growth spend at this ratio conversion to reach that top line growth. So if you reduce your top line growth, you actually become more profitable sooner, because suddenly it looks more profitable better, but you're not making those long-term investments that you should be making. So and if I scroll down here, I have it operating expenses minus growth, and you can see it stayed very flat overall over the last number of quarters, and we expect this to stay roughly flat over the next few years. And that's, if you look at Lemonade's Investor Day, that's roughly what not roughly, that's exactly what they've said. Or they think they can 10x their business with only sort of a marginal increase in your operating expenses, other than your growth spend. So that growth spend will keep increasing kind of lockstep with the company as your amount of overall churn increases, as your overall book business increases, as well as, your relative amount that you're growing, each of dollars growing each year increases, because your overall sort of business itself is growing larger and larger. So you're going to spend more and more and more on growth and on marketing. That's normal for any kind of insurance company. But all the other expenses, we should see a high level of automation. So that's it. Yeah, those are all those key assumptions here. Again, you can get this model, play with those yourselves, but that's how I see, they're going to triple, especially if you're looking at Q1 on a quarterly basis, sort of these gross profits, you're going to triple that or more over the next, year, 2.5 years or so. And while your operating expenses are going to only sort of modestly increase. And then after that, it's going to be, I didn't talk about this in the tweet exactly, but you will see this sort of growth continue at this one trajectory. If I open this up, you're going to see your gross profit continue to increase at a certain trajectory, while your operating expenses only increase at another trajectory, and then that area sort of above the line is going to become massive profits that will grow out into the future. So that's what we all are excited about as Lemonade investors, and I hope you found this video useful. Thank you so much for watching. Remember, it's in the bag.